What's going on, guys? Bexio back, and today we had a brand new video about Jerome Powell, money printer Powell, saying he's going to turn the money printer off early, talking about speeding up the taper, and that's obviously shaking all of the markets, but more importantly, pretty much admitting that he was wrong about inflation. But before we jump into all of that, if you are not subscribed, make sure to smash that sub button because we are on the road to 1,000 subscribers. But we can jump straight in to this article right here talking about Jerome Powell said the Fed's going to discuss speeding up bond buying taper at December meeting. So one of the key points, obviously, to retire transitory. So literally admitting that they were wrong about inflation, coming out here and saying that they were just straight up wrong about inflation because they no longer want to use the term that they set out to use. So looking at all this stuff, you can see Federal Reserve Chairman Jerome Powell indicate Tuesday that central bank could step up removal of its efforts to boost the economy as it battles escalating inflation pressures. Obviously, still in that same kind of term and those boat of they were wrong about inflation, and they don't want to admit they were wrong, but they want to stop using the words they were using before because it's just they were wrong and they can't admit it. We can see the initial tapering schedule would have seen bond purchases wrap up around June. The committee chooses to accelerate. That could mean a close earlier in the spring, giving the Fed leeway to raise interest rates anytime thereafter. This is the big thing that the market and lots of people are worried about, is interest rates being risen, because obviously that's how they're going to fight inflation, is stop printing all this money, first of all, and then raising interest rates. So when they raise interest rates, it's going to make money harder to get. Cheap debt will no longer be an option for a lot of companies to use to grow, and it's just going to kind of tighten the money that's flowing in companies and their ability to grow and go down that type of road. So that's why you're looking into companies. You want to make sure they're kind of got a strong balance sheet coming up to what is happening with this taper. But right now, there is no talks or anything going on about raising interest rates. It's all about stopping the money printer. And I don't even know how long they can actually do that for. See them talking about the Federal Open Market Committee, which sets monetary policy, including interest rates, and the Fed's effort to boost activity through bond purchases, said it's following its November meeting that the pace would be cut by $15 billion a month. That would break down to $10 billion in treasury bonds, and $5 billion in mortgage-backed securities. But here's the problem with this. If they start cutting back on this, obviously the entire reason the Fed started all of this, started printing money, started buying bonds and mortgage-backed securities, was because for mortgages, the private sector didn't want to do it, didn't want to take on the risk. They were already super tight with their monetary policy that the government was giving them. So they couldn't go on, and they didn't want to take this risk of these mortgages. And so the Fed had to step in because they don't have a balance sheet. They don't have to make money. They can just throw all the money out. It doesn't matter. But they also did the buying bonds, and they actually bought individual assets too at the same time, which is crazy. That's like a ridiculous conflict of interest. Bonds are kind of on the line there, but individual assets that they did start buying at least a little bit of earlier is a big problem. But if they did that to bail out the stock market, we saw the market with the massive tank in March of like 2019, 2020, and they had to bail out the market. They came in, flooded it with liquidity, and you saw this absolute explosion in recovery. The question is, are they able to actually stop buying this stuff? Because if the market sees a massive downturn again, are they just going to turn the money printer back on and bail out the market? Because they can't allow the market to just keep going down, and the effects that would have on the economy and things like that. So it's just interesting to see if they're actually going to be able to start this taper or actually taper all the way down to nothing if the market reacts very negatively to this overall. And we can see the market right now currently pricing in at least two quarter percent point hikes in 2022 and possibly a third by December. Well, the September projections from Fed officials pointed to a less aggressive timetable. These projections also will be updated in December. So this is pointing to the interest rates. But with the Fed increasing interest rates also might not be something they can really do, even for a long period of time, because of the amount of debt that's there. And if we increase interest rates, it's going to make the debt, you're not going to be able to really make the payments and pay back the debt and do the obligation that the US and the government and the Fed and all these people have to this debt if they raise interest rates. So keeping interest rates down to make sure that the debt is fine is also coming into play with this factor. And it's just, obviously the decisions aren't easy, but talking about the market's already kind of pricing in a worst case scenario than what the Fed's going to do. But the big question is, can the Fed even do this because of the debt that's outstanding? And obviously, we all know the inflation has been ridiculous. Even just the CPI numbers that they're reporting, 6.2% was November. Well, October's numbers. November's numbers will come out in a couple days here, but 6.2%. This was what the inflation rate was for October 2020 to October 2021. Absolutely crazy numbers, ridiculous stuff. The highest, I think, in like 31 years. And the much more scary part is this right here, the velocity of M2 money. So this is the amount of money in the economy circulating, doing all that types of stuff. And we can see this goes back to 1959. You see the average is kind of around this 1.8 line here. It went higher for a bit here. Dot-com bubble was right here. And then we have the financial crisis, which crashed it again. And it's just been kind of on a downtrend since then. But it's massively moved down from, obviously, January 2020 to where we are now. We zoom in a bit, you can see 2019, end of 2019, beginning of 2020, just this crash down. And then this year, little rebound into kind of stabilizing. And that shows us this is the inflation rate or month-to-month reports for 2021 here. And you can see kind of staying lower here in the first 4 months. That'd be the first quarter. Go back to this Q1, we saw a massive downturn in velocity of money. We go back into here again. The next 4 months, we see it spike up. What do we see? The velocity of money have a move up. And then the velocity of money kind of has been evened out around 1.12, that level here. And we see the inflation kind of evening out too and not really going down, even though the velocity of money is not moving up. So the big issue here is, if we go back to this chart, this is massively low. Even before the crash, it was 1.4, and now it's at 1.1. If velocity of money spikes up and we start seeing money exchanging hands much more often and circulating the economy, inflation will pick up and will go up aggressive. It's just something to keep your eye on, this chart here. Like, if we see this spike up, inflation is going to get hit hard. And if it spikes up rapidly to where it was before this whole crash, which is 1.4, then inflation is going to start really hit hard. And if we think 6.2% is insane, that's without the velocity of money doing anything. If velocity goes up and the inflation is going to just go through the roof, it's going to be so bad. So that's why we could be seeing Powell talking like this, saying, the Fed's got to do something. Because looking out to velocity of money, it's just not going to stay this low forever. The inflation right now could be helping keeping it low, with people, just kind of paying bills and stuff. And, energy costs are up. All these costs are up. But it's just something to kind of keep in mind, where if velocity money goes up, then inflation is going to hit hard. We see that. It's proven right through this whole thing right here. We see this little move from 1.1 to 1.147. So, this isn't even a big spike up, but it is a move up. And this directly coincides with this spike up in inflation right here from year over year, which, is it a coincidence, or is it causing some of this stuff? So we're seeing the Fed really kind of talk about starting to taper early, making sure that inflation isn't going to be some crazy thing. But the Fed does operate in a delay. So even if they cut everything right now, inflation will still be here until it catches up to whatever the Fed's doing and the delay that they're on when their policies actually kick in. So inflation, they're admitting they were wrong. Who could have seen this coming? Literally every single Bitcoiner on Twitter, every investor on Twitter, anyone who is in finance, on Twitter was saying inflation's going to be bad. Well, the Fed and all these economists things were saying, don't worry, inflation's fine. And then they flip flop 3 times before this to finally saying it's finally a problem. But they're not really admitting they're wrong. They can't do that. But that's going to do it for this video. Jerome Powell admitting he's wrong, admitting inflation's a problem, and maybe starting to come after and attack that. And it will have effects on the market, at least short term. The market doesn't really like that. And then interest rates is going to be the next thing to keep an eye on if they're going to up the interest rates. I just don't see how they can do that, at least for a longer period of time, and not have it affect the debts and things they already have outstanding. As always, guys, that's going to do it for this video. Don't forget to smash that like button and subscribe. We're on the road to 1,000 subscribers, and I'll see you guys in my next video.